Hello and welcome. So, you're thinking about buying a home? That's huge. But as you start looking, you're going to hear this term over and over again, the conventional loan. It's like the most common way people buy a house, and today we're going to break it all down. What it is, how it works, and how you can make it work for you.
Right? This is the million-dollar question, sometimes literally. You find the perfect house, the one with a great backyard, but how in the world do you actually pay for it? Well, for most of us, the answer is a mortgage. But, not all mortgages are the same. And that's what brings us here today.
So here's our game plan. First up, we'll get straight on what a conventional loan even is. Then we'll get into your first big decision. Should you go for a 15-year or a 30-year loan? After that, we're tackling the biggest hurdle for pretty much everyone, that dreaded down payment. And finally, we'll look at your toolkit if you don't have that magic 20% ready to go.
All right, let's dive right in and start with the absolute basics. What on earth makes a loan conventional?
Honestly, it's that simple. If the loan isn't backed by the government, like an FHA or a VA loan, then it's conventional. These are the home loans you get from private lenders like your local bank, a credit union, or a mortgage company.
Now, almost all conventional loans are something called amortized. It sounds like a super technical word, but all it means is that you're paying it back with the same steady payment every single month. And each of those payments is a mix of two key things. The principal, that's the actual money you borrowed, and the interest, which is how the lender makes their profit.
Okay, now this is where it gets really interesting. Check out how that mix of principal and interest changes over time. At the very beginning of your loan, believe it or not, most of your payment is just going to interest. But as you keep making those payments month after month, the scale starts to tip. More and more of your money starts chipping away at the principal, the actual loan itself, and that is how you build ownership, or what they call equity, in your home.
Okay, so you're going with a conventional loan. Great. Now you hit your first fork in the road, and it's a big one. How long do you want to be paying this thing off? This decision has some major, long-term financial consequences, so let's break it down.
This really lays out the fundamental trade-off, doesn't it? If you go for a 15-year loan, yeah, your monthly payments are going to be higher. But the upside is huge. You build equity way faster and you save an absolute fortune in interest. On the flip side, the 30-year loan has that lower, much more comfortable monthly payment. But that flexibility right now comes at a steep price later on. So it's a choice. Do you want to pay more now or pay a lot more over time?
And wow, this chart just says it all. I mean, look at this. For a $300,000 loan with the 30-year option, you could pay more than double in total interest. We're talking about a difference of hundreds of thousands of dollars. Seeing it laid out like this really puts that long-term cost into perspective. It's staggering.
All right, so you've picked your loan term. Now you've got to face what is, for most people, the single biggest obstacle to buying a home. No matter what loan you get, you have to bring some of your own cash to the closing table. Yep, we're talking about the down payment.
This is the number everybody talks about in the world of conventional loans. For what feels like forever, the gold standard has been a 20% down payment. Think about it. On a $300,000 house, that's $60,000 in cash. For a lot of people, that number just feels impossible.
So this is the question, right? This is what everyone is wondering. If you don't have that 20% saved up, does that mean the dream of owning a home is just over? No, absolutely not. You have options. And that brings us to our last section. I want you to think of these next two ideas as the most important tools you have for getting a conventional loan, even if you have less than 20% to put down.
So tool number one is something called PMI. Basically, since you're putting less money down, the lender sees you as a bigger risk. So they make you buy an insurance policy. But here's the crucial part. This policy isn't for you. It's to protect the lender if you stop making your payments. It's basically the price you pay for getting into a house with less money down.
The way it works is actually pretty simple. They just add a little extra, the PMI premium, to your monthly mortgage payment. But here's the good news. It's not forever. Once you get to an 80% loan-to-value ratio, that's the LTV you see here, you can actually call your lender and ask them to remove the PMI. And just like that, your monthly payment goes down.
Okay, now for tool number two, which is totally different.
Instead of paying for insurance, you actually take out a second, much smaller loan to cover the rest of your down payment. This is called secondary financing. You might get it from the seller, or sometimes your main lender will structure a deal called an 80-10-10. That's your 80% first mortgage, a 10% second mortgage, and your own 10% cash down payment.
And this table really breaks down why this is so popular. You can see right away that the payments can be very different. The first one, a fully amortized loan, is simple. You pay it off in 5 years, done. But look at those other two. Because you're paying just a tiny bit of principal or even none at all, the monthly payments are way, way lower. And that's key, because when a lender is deciding if you can afford the house, a lower payment on this second loan can make it a lot easier to get approved.
And you knew there had to be a catch, right? I mean, that tiny payment seems amazing, but it sets you up for something down the road that you absolutely have to be ready for.
And here it is, the balloon payment. Because you are barely paying down that second loan, at the end of its term, usually about 5 years, the entire rest of the loan comes due, all at once. This could be a sudden bill for $10,000, $20,000, even $30,000. It's a huge risk if you're not planning for it. So let's just pull this all together. These are the levers you can pull, your financing toolkit. You've got the loan term, where you balance what you can afford each month against what you'll pay in total. You've got PMI, or secondary financing, to get you over that down payment hurdle. And the golden rule is always true. The more cash you can put down up front, the less you're going to pay in the long run. Ultimately, buying a home is just a series of trade-offs. It's a balance between what works for your budget right now and what's best for your financial future. We've laid out all the tools and all the choices, so the only real question left is, which of these trade-offs are the right ones for you?